Hello and welcome to this video. In this video, we'll discuss the effects of economic, political, and other factors on debt securities markets. We will look at some political factors with case study in point being Brexit, and we'll also move on to looking at other examples where macroeconomic factors influence the macroeconomic situation. So let's watch this brief video about bond market behavior in the UK after the Brexit vote.
What does Brexit mean for bond markets, both here in the UK and worldwide? To help us answer that question, we're joined by Bob Michael, who for JP Morgan Asset Management oversees $430 billion worth of bonds. Bob, thanks for joining us.
I'm glad to be here.
So Bob, I think the question for us is Brexit something new for bond markets, or is it just accelerating the trends that you were already having to deal with as an investor?
I think it's a little of each, frankly. I think it is something new. When we look at the markets pre-Brexit and post-Brexit, there is a difference about the preference of bonds that people are looking for. There's a bit more flight to quality and a bit more fleeing and looking for a safe haven and becoming more risk off. I think what's also new about it, frankly, is the uncertainty it's created in the markets. And the capital markets just simply don't like that. They like certainty. They like to know what policymakers in particular are doing. And it's two of the most critical months for the markets. It's July and August when liquidity is thin. I think what is the same for the bond market, frankly, is that there had been demand for bonds over the last couple of years. The amount of quantitative ease coming from the central banks was flowing into bond markets and keeping yields low. That's not going to change.
And I think you've got a chart here which gives us some of the context for sort of what you're looking at as a bond investor.
Yeah, and how the story has changed. When you look at this chart, and it's a chart looking at the percentage of the global bond markets with yields below the 10-year Treasury, and it's something like 85% of the market had a very low yield. Much of the discussion was what the Fed was going to do, and it was all so clear. They weren't going to raise rates in June because they wanted the Brexit vote to clear. There was enough growth and inflation in the U.S. for them to do it, so they would come into the July meeting and raise rates another 25 basis points. I think you can take that off the table, and I think it makes the U.S. bond market particularly attractive.
So what do you think is going to happen from here? What do you see sort of for the UK and sort of for US investors? How are they going to react to this?
Well, I think there are going to be a couple of things that are going to happen. I think certainly there's going to be an acceleration of money into bonds. But I think that money, which had been going into things with a bit more risk, so high yield, emerging markets, things with structure, credit, and liquidity risk, that will tail off, and there will be more of a flight to quality trend. I like to say the things that the central banks are buying and investing in, those will get the best bid. So governments, high quality corporates, and then one degree of separation from that. So even though the Fed isn't buying US corporates, you'll get some spillover from the ECB and the Bank of England.
So we should see that buying push down yields ever closer to zero, certainly in Europe. And where do you think they go in the US?
Well, I think they're going to go substantially lower. I think right now we're looking at a 10-year Treasury yield at about 1.5%. I think it's going to close in at 1%. I think 10-year gilt yields are going to go lower as well. I think that they could go down to 50 basis points. If I were the MPC, I would take that one question in the market about what their policy is going to look like and take it off the table. I would cut rates to zero today.
And we've got one final chart here. What is this showing us in terms of this is the US financial condition?
Yeah, and this is a measure of whether financial conditions are tightening or easing. It's something that Yellen looks at. She looks at two pools of data. One is the typical fundamental data, so growth and inflationary pressures. The other is financial data. And the key inputs to financial conditions are credit spreads, the equity market volatility, and the strength of the dollar. Financial conditions are tightening as this line is rising. And this is telling us that financial conditions were quite tight. They have to come down a bit, and this is something that the Fed has to look at when they take monetary policy into consideration.
Great. Thank you very much for joining us, Bob.
Thank you.
All right, so in the aftermath of Brexit, the UK bond yield ratings were downgraded, reflecting higher credit risk spread, whereas the long-term yields declined. So we can actually look at this by visiting these links, these charts. Basically, the 10-year UK gilts, yield on a 10-year UK bond. As you can see, this is a short-term chart, so let's look at a 3-year, over a 3-year horizon. As you can see, it dipped since the beginning of the year, this year, it actually dipped, which reflects this so-called flight to quality or safe haven, as was mentioned in the video. So this one basically shows the UK's yield curve or term structure of interest rates going from 0 to 50 years. As you can see, the short end, which means that from 0 to up to 6 years, you can see it's inverted or it's not normal. So the shorter term bond yields are higher than the longer term bond yields up until 7 year here, and then it starts going up. Actually, up until the 10-year, the short term bond yields are actually higher than the long term. So from the 11th year onwards, then it's actually slopes upward. But as you can see, going from the 30 years to the 50 year, again, it's kind of flat or even slightly inverted. And that's not normal, and it's not a sign of a growing economy. And this one actually shows you the pound to the US dollar exchange rate. As you can see, the pound has been quite volatile. Exchange rate has been quite volatile since the Brexit vote. And that reflects the uncertainty over what's going to happen in terms of trade, in terms of overall inflationary environment, etc. So as you can see, this is the 24th of June when the Brexit vote was delivered, and as you can see, there was a collapse. The pound actually dropped significantly overnight here, and actually has kept mostly was down since then, and went as low as 1.19, and that happened actually September 2019. So all of these basically mention that political events such as Brexit actually can significantly weigh on the financial markets, including the currencies, the bonds, etc. So I don't have the example of the UK stock market, but if we look at the stock market, which you can actually look it up, you can also see that the returns on the FTSE 100 is actually much less attractive compared to the returns on other indices, such as the US S&P 500. In the next video, we're going to go through the macroeconomic factors, including economic growth, sovereign solvency, demographic change, etc. And also, we're going to look at some central bank, how the central bank policy may play catch up with the inflationary expectations or expectations of the rates in the future.